Welcome, good morning. It's always a pleasure speaking with you.
Good morning. Good morning.
So, just first give us perspective. Do you think enough is done on the liquidity front? Because that's one of the key problems currently in the financial sector.
So, our house view wasn't that the stance would be changed. We were expecting a continuation of the existing stance, but now that it has been done, we will wait to see as the governor himself said that should all the conditions should align and the risks in geopolitical terms and also commodity prices, etc., should not materialize. So therefore, we continue to hold the view that January, February would be the time when probably a rate cut might happen. In terms of liquidity, as you asked, I think the liquidity overall is good, and the RBI always says that the system liquidity is satisfactory. What we are seeing is that though there is a tempering of the credit growth as also the deposit growth, leading to the gap between them coming down to almost 150 basis points, which is the lowest since May 2022. So therefore, this has come down and therefore reduced some pressure on the lending and deposits. But still, the gap continues. So therefore, as long as credit growth is higher than the deposit growth, we will continue to see some pressure in terms of liquidity and therefore margins.
Right. So you spoke about credit growth getting tempered. Is that visible on the ground, and do you believe it's going to also impact GDP growth? Because currently, RBI's estimates of GDP remain unchanged. Do you believe RBI can do the 7.5%? Or
So
rather, India can do the 7.5%, which RBI expects. Sorry.
So this credit growth slowing, which I talked about, is a very recent phenomena. It's the last month or two numbers.
Right.
Whether this will continue in the same manner, one doesn't know, because what we are seeing that even as unsecured loans, etc., the growth has come down in line with what the RBI wanted. But on the other side, the construction growth, the real estate has picked up very strongly, and infrastructure continues to go strong because after Q1, where because of elections, the project draws, etc., were not happening on the government side, it has again picked up. So our view is that overall the credit growth will continue to be in the range of 13 to 15%. It is lower than the earlier 15 to 17, but one has to remember that the base is also higher. So on a higher base, this number in absolute terms, it's still continuing to be higher. So if the credit growth comes down secularly, then surely it will impact the GDP. But I don't think we hold that view as yet.
Got it. So it may temper, but not as much. Talk to us about deposit rates, sir. In the system, of course, they likely have peaked. What's your view? If at all a repo rate could come, maybe say in December or say in February following that, do you believe that rates will come down? Will deposit rates at all get impacted, or will deposit rates remain elevated?
So deposit rates come down after the rate cuts happen, but always with a lag, because those who are logged into fixed deposits will surely wait for maturity to happen before they are repriced. So in that sense, there will be a 2 to 3 quarter lag before deposit rates start to show downward trend. But as I pointed out, the credit growth continues to outpace the deposit growth. And as long as that continues, there'll be pressure on deposit rates, and so far we haven't seen deposit rates coming down in any manner at all. And in fact, depending on the requirements, certain buckets, banks continue to raise deposit rates. So to your point, I do not know whether the deposit rates have peaked currently. We may see some more increase if the credit growth continues in the manner. And going forward, of course, one way which the banks have to think about, and some of us have already started doing, is to look at other instruments, market instruments, to actually fund our growth. Deposit, of course, is the most stable, but infrastructure bonds, for example, the other kind of bonds, those CPs, those instruments also can be used by the banks as if the rates there are showing a lower trajectory as far as deposits compared to the deposit rates. And currently that seems to be the case.
Right. So, sir, margin pressure will only increase going forward as rates come off. The banking system will see margin pressure. How should one read into loan to deposit and margins, if you can give us perspective?
So loan to deposit has been coming down because, as you have seen, many of the banks have very aggressively raised deposits, even if at higher costs,
Yes.
and have kind of tempered their loan growth, especially in the unsecured side. Some have even sold portfolios, and our, of course, CD ratio continues to be around 70 odd percent.
Right.
So therefore, we are relatively better. But there are other banks who have taken steps to reduce the CD ratio. Margin pressures, yes, will increase were the rate cut to happen. But we have to remember that the T-bill rate, the 3 T-bill rate, which is a key parameter for us, has actually come down from somewhere around 6.9 to somewhere around 6.6 or below. In fact, I think the last number was 6.47. So already about 50 basis point short-term rate has come down on the lending side, even without any RBI cut. So I think if the cut happens, this will further come down. And to that extent, deposits being priced with a lag, clearly the pressure on margins will initially be there.
Okay. And so, we had the governor also talk about the MSME loan growth that's been there, or rather NBFC loan growth that's been extremely strong, and some concerns with regard to processes, practices, policies that NBFCs have been using to lend, risk adjusted. You have a great pulse with how things are happening on ground. Just talk us through whether you believe that there are large gaps and what sectors should one be concerned about, or what sectors would you be concerned about?
So therefore, on NBFCs, I think the governor made a great point. One is that he acknowledged that they play an important role in financial inclusion by reaching out to unserved or underserved sectors where the ticket size is smaller, and therefore the banks will find it hard to actually reach out and have mechanisms to lend and also to collect. So that is therefore the importance of having this sector resilient. On the other side, he pointed out that wherever there has been a infusion of capital and the capital ratios are very high, and some of the NBFCs have been chasing growth for the sake of growth, basis the targets rather than actually seeing potential and therefore doing that. And once somebody does that, then there is always a pressure on using shortcuts, on seeing whether there is a sustainable risk management framework behind the and to back up the loan growth. I think those are the warnings he was issuing. As far as we are concerned, we see the entire gamut. There are, of course, NBFCs which are very well run, which are linked to some large corporate houses, and which are conservative and which are very selective about which segments they want to target. And we are very comfortable with them and their growth plans. And there are other NBFCs, of course, which are focused on the consumption side loans largely, unsecured loans, gold loans, and so on. And there we continue to monitor not only the portfolio, but also their risk management practices, their audit reports, and the external things, and the ASM, which is the specialized agency for specialized monitoring, which are essentially firms which we hire to actually look at the portfolio and sample on the sample basis, look at the actual availability and the strength of the portfolio. So all those monitoring steps we are following. And of course, there is also one segment which is lower rated, where the growth numbers are high, and we are very cautious in terms of lending to such NBFCs. It's a full range. And that's what probably the governor also pointed out, that growth is okay, but if the growth is high on the basis of without having the adequate backup systems, that is a risky thing. And I'm sure the RBI, with their individual bilateral conversations with those NBFCs, are taking those steps to warn them about these kind of practices.
Excellent. Thank you so much, sir, for the perspective. It's always great having perspective from you on policy days. So thank you for coming in and giving us that.
Thank you. Thank you very much.